and welcome to India Market Open. It's an action-packed morning, lots to watch out for, 2 new listings, macro news flow as well that we track. Markets, of course, will be the key focus. Niraj, we've clearly missed you. You've been missing and the markets have been relatively quiet, but you've come back with literally lots and lots of action-packed day.
And lots of Rajasthan goodies, by the way, in the canteen. So that too. But yeah, you know, it's interesting, right, guys? I mean, we'll talk more about it, but steady as she goes, and no matter how much disbelievers are of the belief that it's looking stretched, but US and Asia following US is just looking very, very healthy.
And crude, of course, giving its support for whatever reason you want to call it. So risk assets are back on.
Yeah, absolutely. And, you know, what you're seeing is a trend all over the world. In fact, let's just start with what we've seen overnight. And that idea of last 8-9 weeks of positive trends continues in the US as well. So Wall Street continues its winning streak overnight. The NASDAQ closes above 15,000 levels for the very first time. Oil prices are rising on Red Sea attacks. We know that Houthis have been attacking with missiles and drones, ships passing through the Red Sea. But on the other hand, you have an operation called Operation Prosperity Guardian, no less, with 10 nations led by America saying that they will protect that Suez Canal. So you've seen Brent managing to stay above $79 per barrel, but not too much of a panic movement there. The 10-year benchmark has also been steady. Overnight, the big story actually for Indian markets in terms of at least the IT pack has been the Accenture Q1 numbers, where revenues have been up 3% at 16 billion. This is a little shy of estimates at 16.22 billion. Operating incomes have been down 1.15%, and operating margins are down 70 basis points as well. Your pain points continue to be that, you know, their full year guidance is between 2 to 5% local currency. So that's not looking too exciting. And they've seen weakness at -2 to 2% growth. How is this going to work out for Indian IT companies, which are already under pressure, is a question we're going to address in more detail on the show, isn't it, Samina?
Yeah, indeed. It is looking like an exciting morning, actually. Lots and lots of positive cues, like you highlighted for us, Tamanna. GIFT Nifty also indicating to another positive start. Remember, what we did see yesterday was the markets trading in a very narrow range. We kissed 21,500, but closed below those levels. Niraj, like I said, while you were missing, it was quiet, but we did kissed 21,500 literally in the last half an hour of trade, but of course ended below that. Broader markets as well have been underperforming. So there is some profit taking happening across the small and the mid-cap space. And interestingly, defensives, maybe led by Nestle, so consumption saw some buying emerging yesterday.
Yeah, it was interesting. I mean, maybe too early to call a trend, but you know,
no trend really.
Yeah, I mean, liquidity. I mean, I was just looking at a statistic. If I'm not, unless I read it completely wrongly, $36 billion into the S&P 500 ETF in the last 1 week. $36 billion. Just the mad euphoria of a liquidity-driven rally. So don't confuse a bull market with intelligence. But yeah, you know, we've kind of, I mean, you guys hit the nail on the head. It's been a bit of a consolidation with a range for the Nifty. The FI positions on the index longs are still above that 58-59%. So that end of the market continues. I just think Tamanna was pointing it out. The global markets are very sanguine about the Red Sea issue for now. Now, I'm not comparing this with Evergrande, but something like this similar happened. Now, the markets are looking for a reason to correct. Does this give them the reason? Let's wait and watch. For now, the markets are sanguine, and as I think we pointed out, the US and some other countries are saying that we'll kind of protect that. But already hearing Maersk and some others saying that they are rerouting their routes as well. So let's wait and watch what happens there. That might be something that might be a concern if it snowballs into something bigger. And while FMCG has shown a bit of a spark, too early to maybe call it a trend, they have started to deceive now a number of times. Let's see if this time around is more of the same or no. And therefore, after coming back, I was speaking to 2 or 3 HNI investors about what is it that they have seen in the markets the last couple of days, and what is it that they would be looking cherry picking. Defense, real estate ancillaries, defense ancillaries. That seems to be the pocket that everybody seems to be betting on for now. So Liquidity, yes. Some trends developing, yes. IT might have a bit of a backseat today, maybe. So lots of things developing.
I just wanted to come in on the point, Niraj, that you were making of the kind of optimism that we're seeing, despite a number of Fed officials trying desperately to bring some sanity in statements after statements. Two more statements actually will be coming in, and we'll have those details tomorrow. And they're saying very clearly that relax. But the markets are just not in the mood to listen to that. There is something else that they have their sights set on.
Yeah, most certainly. And maybe the market's saying central bankers, let them comment on policy and rates. Markets will take care of it. But yeah, it's just been crazy, the kind of moves into S&P 500
you were
for sure.
talking about liquidity and the fact that you can't question emotion and liquidity, right? I mean, it's just so personal. But just to put that in context, and that's the rally. Every mutual fund that's played momentum in the last couple of months has done exceptionally well. So Alpha has come in. Worth noting, a fund like a UTI Momentum, Niraj, 49-50% returns year to date. You look at an active value fund, those returns are not even close, right? So it just goes to show that you can't fight liquidity. The other point that I want to make, and you were talking about how this market is flood, case in point, Unified PMS has stopped taking fresh cash.
Equitas has stopped taking cash as
Which
well.
means there is value that's now beginning to miss. So cherry picking those sectors and stocks has only gotten much harder in the last couple of weeks, or couple of months, should I say. But let's talk about other stocks that we will be tracking. It is going to be an exciting morning. We've highlighted why global cues are looking positive. December usually is a quiet month for flows, but this time around the picture looks slightly different, if I may say. Quick check on the counters specifically that we are tracking. Sectors like IT will be in focus. Remember, Accenture posted numbers yesterday, a slight miss, but their guidance remains flat. And of course, it'd be interesting to see, because historically when Accenture reports, Indian IT stocks react either positively or negatively to that. We'll take a check of stocks beyond the IT sector. So you've got one important one to track this morning is going to be Embassy REIT. In the last 2 weeks, this is Blackstone's second exit. Remember, they marked an exit from Axis Bank early this month. Now they're looking to sell their complete stake in Embassy REIT of 23.6%. The floor price is set at 310 rupees. What's worth noting is that a lot of these private equity VC funds are making exits towards this year end. One being they probably were looking at exits from the early part of the year, but the markets did not give them the opportunity to do so. And I think you want to come in.
Just that this is a clean out trade. So this is the large of the stake sales to happen, but because it's 23%, there might be pressure on the stock because it's a large thing to be absorbed.
It should, for whatever it's worth. Even a 5% exit in the last couple of weeks we've seen has impacted the counter dramatically.
But the last stake sale in Embassy REIT, sorry, just
not the last one from Blackstone.
Precisely.
So Embassy REIT, that's the last leg, like Niraj indicated. This is all they own in the company. We'll of course love to see where else Blackstone would be looking to mark exits. It's year end, so it's year closing. Private equity players need to go out and do distribution to their investors, and with a period of 5 to 7 years of holding, some of these companies aren't even trading close to the listing price. So Embassy, for example, is only about now trading closer to its listing price. So no major gains, but of course an exit is what we're seeing on that counter today. Varun Beverages, yesterday was all about Devyani making that acquisition in Thailand. Today Varun Beverages has gone out and picked up 100% stake in South Africa's Bevco. Remember, Varun Beverages does bottling for Coca-Cola and PepsiCo, and that was the biggest story a few years ago when this company listed. Now, of course, looking at the world, South Africa is a market they're venturing into. That market has Coca-Cola as the lead player, but pretty confident that Varun Beverages should make this a success too. Couple of buy calls have come in on this. CLS has upgraded the counter. Jefferies as well retains a buy call on Varun Beverages. It's a fairly large transaction to the tune of 1,320 crores, but very sweet business model, and that's what Varun Beverages is all about. The stock as well ended with a gain of 3.5% yesterday. JK Tyres, another morning, another QIP. You've got JK Tyres opening its QIP to the tune of 500 odd crores. Floor price is set at a 5.2% discount, so watch out for this one. Some pressure on the counter cannot be ruled out. So yes, guys, stock specific, sector specific, no major trend, but it'll be interesting to see how things play out in opening this morning.
Yeah, absolutely. Just a few more counters if you want to put on your watch list, definitely on our watch list this morning. Glenmark, one of them. The CCI has approved the acquisition of majority shareholding by Nirma. So that's more of a tick, but will be perhaps positive. Nippon Life India, AMC, is a story that, worth following, worth tracking. IndusInd Bank will be selling about 2.86% via block deal. The floor price there is 426 per share. NMDC is one that I'm putting on my list, and a whole set of mining companies as well. So, statement yesterday by the Coal Minister Prahlad Joshi saying that nearly 100 blocks of critical minerals will be put on auction before February next year. So that entire pack is worth watching out for. I've put NMDC on that list for now. Jubilant Foodworks is also something that we can look at. The Jubilant Foodworks Netherlands will be launching a cash offer to acquire remaining 45.33% stake in DP Eurasia. That stock was showing some signs of life yesterday. BPCL as well. The company has approved a proposal to set up a 400 KTPA polypropylene unit at Kochi. The project cost is about 5,000 crores and funded in debt equity ratio of 65-35. Anyway, the entire crude impact will need to be seen on BPCL, HPCL, ONGC. We saw ONGC doing fairly well yesterday. Some of the ones on your radar, Niraj, especially in terms of delivery volumes.
Yeah, but just before I get to that, Tamanna, the interesting piece for both Jubilant as well as Varun. Varun Beverages trades at 10 or 11 times market cap to sales. Yeah. The acquisition that they're doing is 0.83 EV to sales. So just for whichever company is able to do a swap via either equity or otherwise, just the headroom that they have for giving out their expensive equity in terms of versus the cheap equity is quite stunning. And the fact that they are going ahead and making acquisitions at such rates just shows the ability of these Indian companies to do that. We spoke... IT should be in focus because one, Accenture Q2 guidance weaker than anticipated, and Accenture went out and said that bookings have improved, but clients don't appear ready to spend yet. Now, this is December. If this is happening now from Accenture, very likely that the commentary from the IT companies in January is not going to be different. Yeah. About 20 days ago, 25 days ago, we had that City note, and Surendra Goyal is a sharp IT brain. For him to have met all the large companies and come out and put out a sell on Wipro and some of the others, and suddenly in 15 days, you're saying that the things have changed. I mean, there's just exuberance out there.
Quarter 3 and quarter 4 are anyway weak quarters for IT companies. So I don't think expectations honestly are running that high. And what I think we were talking about this a few weeks ago, while we are all getting excited that there's a rate cut in the offing, it's at no stage has the US Fed indicated that the recession is behind us. The fact remains margins are going to be impacted. A stronger rupee does not garner well for exporters. So margins for sure under pressure as well.
No, so on recession, so technically the US went into recession for 1 quarter, but as per the US government, it wasn't a recession. We were speaking with Andrew Holland.
When there's actually a recession.
So Andrew Holland was saying yesterday that he thinks there might be one, others have been saying no. So it's still out there. But then market exuberance is on, another level. Yeah.
Most certainly. And just the last couple of stocks before we get in our guest, Nalco and Hind Copper might be in focus because Kanji Bidesh is in advanced stages of discussions to buy a lithium mine in Argentina. Now, this is a India to India move, but it's happening via Kanji Bidesh, which is a JV of Nalco, Hindustan Copper, and Mineral Exploration and Consultancy. So watch out for this one. It's an interesting one. I may not have an immediate stock impact, but it certainly is an interesting one. By the way, JK Tyre is the last one.
Did a big run up in the last hour of trade.
Because copper prices have also done well. Yeah, 5% higher yesterday. But pretty interesting. And just lastly, we're talking about block deals and QIPs. JK Tyre has opened a QIP to raise up to 500 crores. They've set the floor price of the QIP at 358, a discount of 5%. Sorry, I missed out that you've covered it already. Okay, but the conversation is around what's happening to flows, because flows continue to be very strong in a bunch of countries, including India. Cameron Brand, Director of Research at EPFR, joins in this morning to tell us his thoughts on what's happening to flows at large. Cameron, great having you. Thanks so much for taking the time out. And good morning from India.
Good evening from Boston.
Thank you so much. So, Cameron, what's your sense about the kind of flows that we've seen into emerging markets at large in the last 2-3 months? And as also, by the way, as some data was suggesting that flows into even an S&P 500 ETF have been very, very strong of late.
So I'll tackle that one first. The reaction to the latest Fed meeting was exuberant. I don't think there's any other word for it. The day of the decision, up until that point, net flows had been about 1.5 billion into U.S. equity funds. At the end of that day, the net figure had climbed to 25 billion. Very strong reaction to the perceived dovishness of the Fed comments after the meeting. Hasn't spilled over into a new pattern for emerging markets yet. We're still seeing a reluctance to commit to the diversified global emerging markets funds, which reflect the broader story. But as has been the case for much of the year, bar a brief kind of lull, late third, early fourth quarter, funds offering exposure to the major emerging markets in Asia continue to do very well. China, India, and dedicated India funds, I think, have been the most consistent money magnets for 3 quarters. Taiwan equity funds continue to do very well. We have seen a loss of momentum for Korean equity funds, but overall, when people think emerging markets, they're thinking the big 3 or 4 in South and Southeast Asia.
Cameron, I know you're not predictive and we won't get there, but just a question of whether this time the kind of, I heard you say that 3 quarters in a row, we are seeing funds, India dedicated funds also see some serious inflows. Is this different than what's happened in the past? Because for a lot of corporates globally, the investments of the FDI investments into India are a lot larger than what they've done in the past. Have India dedicated funds shown that kind of tendency to relative to what's happened in the past?
Yes, they've been stronger for longer. I mean, we were all fixated on higher for longer with U.S. interest rates. But in terms of flows to a dedicated emerging markets country fund group, I haven't seen this consistency of flows week in, week out to dedicated India funds. And I've been kind of keeping an eye on them now for over 2 decades.
It's Samina joining in as well. A couple of questions actually. With India's entry into the JP Morgan bond index, what is the nature of these flows? So is this all moving to India-specific equity funds, or are you also seeing inflows coming into the Indian debt market?
Much less so. The Indian debt market, the funds dedicated to those, enjoyed, strong support, sort of, I would say, particularly from about 2018 and to just before the pandemic happened. Since then, the focus has shifted to other Asian markets. We saw a period of interest in Malaysian debt. Until recently, funds dedicated to Korea have been very strong. But no, the real interest in India has been on the equity side, and it's been at a very high level.
And Cameron, what is the quality of this fund? Is this serious long-term money coming into India, so pension funds, etc., that are already entering the Indian equity market? Or is this transitional money moving from one emerging market to the other for the short term?
My sense of it is that it's though there certainly is some ETF action, that this is the kind of money you want. There aren't a lot of good options out there at the moment. Certainly if
All right. We seem to have lost that feed. We'll try and get Cameron Brandt on right now. But the big story has been definitely fund flows.
Yeah, but it's interesting, Tamanna, that he's saying that 3 quarters in a row, India dedicated funds are seeing flows which are different from what we've seen in the past.
So, the whole story that this has necessarily started only after the 3rd of December results is not the case. It has been a consistent sort of interest from foreign investors. And we have Cameron Brand back with us. Cameron, I hope you can hear me. This is Tamanna here.
I can.
Absolute pleasure to speak with you here from the NDTV Profit studios. I had a broader question actually for you. What is the reason why India is becoming such an attractive destination for these kinds of investments? Is it because we're looking better compared to China? And I just want to get your sense, because the narrative sitting here is that things have changed. We have political stability. We're looking like a bright spot compared to everyone else. But what is the perspective from your end?
Two things. One, which you just mentioned, which is that investors really have been forced to revisit a lot of their assumptions about China, and a good number of them, are, especially foreign ones, are taking money off the table, which has certainly.
All right, so a bit of a patchy line there, but the picture is looking very, very interesting as far as foreign fund flows are concerned. And of course, December has been a whopper of a month. Great to speak with Cameron Brand there. But I want to move to a story, a big one actually, which you saw first on NDTV Profit last evening, and all of those details, you must go to the website ndtvprofit.com and look at more details there. But we're talking about the RBI's crackdown on a misuse of alternate investment fund. Deals worth 20,000 crores are expected to be hit. I have Vishwanath with me. He's joining us in the studio. Vishwanath, first of all, what is the big purpose over here? What has the RBI done? Why has it done it?
For the stated purpose, as the RBI says, is controlling evergreening of loans. Now, that's they're saying that while in their due course of business, banks and NBFCs do invest in AIFs, it's normal for them. But there have been situations which have come to the RBI's notice which may raise regulatory concerns, specifically with regard to overgreening of loans. So the issue with what is happening with the AIFs, in what RBI is trying to address here, is any kind of round tripping of funds, circular sort of lending, where if an account has turned NPA, you go through an AIF route and try and fund it through that route and help the company come back to normal. So that the RBI says is against the principles of lending, principles of regulation that the RBI sets. So that's what they're trying to control. Now, this 20,000 crore, this number essentially refers to deals which could have evergreening, which may also have other violations, other regulatory violations, which also need to be addressed. What one of the experts I was speaking with was telling me was that some people are spitting on the road, the others are committing murder on the road. So instead of dealing with everybody differently, what the RBI said is that I'm going to shut the road now. Nobody's allowed in this at all. That's where the RBI is coming from, Tamanna.
But I'm saying, so I just want to look at it in the context of what the RBI did with small ticket loans a few weeks ago, and now over here. And we'll get into the details. This is Jeffrey's note on impact on IFLP Ramal. They're saying it could be limited. But from a regulatory framework, this looks like the RBI sending out a message that I mean business. There is a set of concern coming in because of the exuberance and the amount of liquidity in the system.
You're right. So what happened was about a month ago, exactly a month ago, the RBI came up against unsecured lending and said that, listen, if you are going to be growing this business, you'll have to pay a little bit more. You can't have unchecked growth within the unsecured ecosystem. Now, a month later, they're coming against corporate loans and saying, if you are trying to play the system and try to fund these borrowers through alternative routes, then we're going to put a stop to that. What you said about RBI meaning business, now, the RBI governor during the monetary policy statement also made it very, very clear. We are not going to wait till the house is on fire, till the house catches on fire. We are going to act much before. And this was a criticism of most regulatory authorities over the last decade, was that they were probably a little too late in acting. And now, of course, the RBI is saying that we're not going to wait till things go bad.
Vishy, so let's just put this in perspective. Now, what does this mean for who?
Yeah.
In the AIF category, you've got Cat 1, Cat 2, Cat 3. Cat 2, of course, in India, classification is not based on assets, but based on the category of risk and taxation.
Yeah.
AIF's category 2 is what this largely covers, where a lot of your debt AIFs, so an Ulterior, and I'm not indicating by any means that these are the guys who are going to be questioned, Ulterior, Vivirthi, JM, Edelweiss, Kotak, all these guys had structured NCDs and debt funds, of course unlisted, giving out yields of 12 to 13%. This is in a year when equity markets were not giving you alpha. So the only option you had to was hopefully go for good quality debt, good quality at 13%, unlikely, but that was what was happening. Now this is restricted to debt investors, A, and AIF Cat 2 as a minimum investment limit. So this definitely doesn't impact even debt investors who are retail in nature, right? So this is restricted to the ultra HNIs. More importantly, to people who've used debt as an instrument to generate alpha as opposed to equity. Fair assumption?
Fair assumption, but I mean, I'll not veer into names because we don't have any proof of who's actually involved in this. But the fact is that this definitely only focuses on the debt side of the story, structured debt side of the story. Credit funds who essentially dealt in any kind of credit, private credit especially, that is where the questions will rise. How many of those funds are strong, fundamentally strong, good? And which part of that is a problem area? None of that is clear at this stage.
Also, if they're getting the money from the banks, right, from the lenders, if they're not, if I'm a credit fund, if my entire set of investors is not a bank who's giving me 50 crores, but a set of investors who accredited investors who know the risk, then I don't get hampered.
You don't need to worry about that.
The fact of the matter is, if you're earning a premium on it, there is obviously some risk involved. If these were AAA plus corporates going to the market, there would be no concern because they'd raise debt at a much lower price.
Absolutely.
Right? Or lower yield.
So as long as banks who inadvertently are involved with the borrowers who will end up being beneficiaries of these funds, that is the area where the problem is.
And these would be banks who have an NBFC? So would probably be in the brokerage business,
or otherwise, even NBFCs themselves could be part of that investment.
What sectors would seem most vulnerable? We've talked about what organizations or NBFCs on this side, but in terms of the ultimate borrowers who may be trying to evergreen, etc.
So what we are picking up from the market is largely real estate, largely infrastructure related borrowers who might be tapping this market for funds. They are the ones who probably have this situation, because usually what happens is project completion requires a certain time frame, and if you're not able to meet that time frame, then the bank needs to classify that account as an NPA, or the NBFC needs to classify that account as an NPA. And once it's classified as an NPA, you can't really lend to them again. So you use this route to fund them till project completion. But of course, all of that goes into a tizzy right now.
That's the catch. That who is on the other end over there, looking perhaps vulnerable. We don't know names yet, but we'll have to wait and see if this has a massive impact today or down the line.
For sure.
Thank you for that, Vishwanath Nair there. But, you know, he was referring to the RBI governor's statement saying that I'm not going to wait for the house to catch on fire. It's a statement he made on the 8th of December. Let's just play that out for you.
Financial stability, as we have stated before, is a public good. The Reserve Bank judiciously uses micro and macro-prudential tools to safeguard financial stability. The recent preemptive measures taken by the Reserve Bank in respect of banks and NBFCs were geared towards addressing potential risks and preserving the resilience of the financial sector. We do not wait for the house to catch fire and then act. Prudence at all times should be the guiding principle, should be the guiding philosophy, both for the regulators as well as the regulated entities.
In mind this discussion that we've had, by no means we are saying that the entire set of players are going to be having a problem with growth, if anything. It is a few players which get that kind of money, which is lent to the borrowers of the investors, which is not a very wide bucket. So please keep that in mind. And any names that might have been spoken are essentially for illustrative purposes. A lot of players are into this space. Some of them might have an issue with growth. But we need to slip into a quick break. Up next, something that we do at 8:30 every day, a set of what the futures and options markets are indicating.
watching the India market open. A quick look at the GIFT Nifty before we hit the headlines at this hour. And it's looking like we will have an exciting morning. Definite gap up going into trade. So we see that steam, that stamina continue in the markets after hitting a 21,500 level on the Nifty, but receding at close. Quick look at the headlines at this hour. From the global markets, US markets end higher as Dow, Nasdaq notch 9 days of gains. Asian markets mostly trade higher as Hang Seng, Nikkei gain over 1%. Shanghai trades flat, GIFT Nifty above 21,600. IT heavyweights will be in focus as Accenture flags weakness in Q2. Oil prices continue to rise as shippers take a detour, divert over $35 billion worth of cargo. Supply chains are disrupted. And RBI cracks down on misuse of alternate investment funds. Funds worth 20,000 crore rupees will be hit. It's an action-packed day ahead for primary markets as well. DOMS and India Shelter list after record subscriptions. But let's go across to Agam to get the picture on the F&O side.
Right. So markets look overbought, but who's to say there's no upside at the moment, right? What we're looking at the moment is while we did see marginal cues coming in from the benchmarks, we are still seeing a lot more accumulation in open interest towards longs potentially, even as the index, that is the Nifty 50, advances marginally in the green, another 8% added in OI. The Bank Nifty all as well has seen an increase of nearly 4% in open interest, even as the spot remains flattish. The question really is, where do we go from here? Of course, the Bank Nifty will also be in focus on account of the weekly options expiry. We'll talk about that in just a minute. But before that, let's also address how things are stacking up as far as your options market is concerned. So this is the change in OI yesterday. We did see a lot of activity around the 21,300, 400, and 500 calls as well as puts, but calls specifically seeing more writing around the 21,500 mark, and we've seen an equal amount of puts activity around there. So I reckon that we are looking at traders perhaps at the moment taking a lot more and betting on the 21,500. Should we open about 21,500 and sustain about that mark? Well, you never know. We could in fact start seeing a lot of covering as far as those specific calls are concerned. And speaking of those calls, as you can see at the moment, we are seeing maximum open interest around the 21,500. And well, again, it's going to perhaps trigger some amount of covering, and that could in fact also push the Nifty even higher if we do in fact see that covering coming through. On the higher end, of course, keeping an eye on 22,000, that will perhaps serve as a near-term a resistance on the upper end based on that kind of accumulation that we've seen in calls. On the lower end, of course, 21,300 serves as a little bit of a support for now. But it is the Bank Nifty weekly options expiry, and that's where all the focus is going to be. At the moment, around the 48,000 mark, it's been a little bit of a hurdle. It's been a little bit of a fight around 48,000 because the Bank Nifty keeps going above and keeps coming back below that. And for now, considering that we have most amount of accumulation around there as far as the calls are concerned, today as well, it could be a little bit of a fight. So that's a wait and watch on that one. Let's talk about stocks then. And in terms of those stocks, which in fact did see a lot of increase in open interest towards longs, Nestle, Delta Corp, Shriram Finance, along with Metropolis. Apollo Tyres, it really didn't see too much change in its underlying yesterday at the end of the day, but it did see some shorts. And of course, as far as those stocks which saw unwinding in open interest, we saw about a short covering for Ramco Cement, Aurobindo Pharma, and Berger Paints, and RBL Bank along with Deepak Nitrite saw a bout of longs and winding. Deepak Nitrite, of course, will be in focus based on its expansion in its capacity. So you never know how things could, in fact, change for that counter. Keep an eye on that one as well. But this is as far as your market participants go. What is this F&O data telling us, and where could this potentially lead us going forward into the next couple of sessions? Well, to answer that, we have Soni Patnaik of JM Financial who's joining us on the show. Soni, good morning and thanks for joining in. Let's once again start with your view on the benchmarks. How are you trading them?
Good morning, Agam and Tamanna. Thank you so much for having me on the show. So I think rightly the way you've pointed out, the way Nifty has added another 8% of long builder positions yesterday. We've also seen a lot of aggressive put writing, continuously. Even when the markets were down, we saw put writing taking place in 21,300, 21,400. So it was indicating at a very strong pullback. On immediate basis, 21,300 continues to be a very strong support for Nifty. And today's gap up above 21,500 is just the way where, the gap up can cause the call writers at 21,500 to exit that position and move on to another strike. So most likely, if the gap up is sustaining for at least say 1 hour post opening today, we would see that Nifty can see another round of extended piece of rally going up to 21,650, 21,700 by expiry tomorrow. So it's a bullish structure, it's a bullish setup. And as long as I think 21,300 is holding, it may eventually try to head towards 22,000 by December end also. So I think that would be a little more of a rally, more of a bullish sentiment. Although coming to Bank Nifty is facing some resistance around 48,000. Again, provided the gap up, we can see it crossing 48,000. Then Bank Nifty can definitely head towards 48,500, 48,700 for this today's expiry day. It will all depend upon how the call and put writers are behaving after the gap up opening that we see, and how long is that gap up sustaining. Eventually, even Bank Nifty has formed a very strong support of 47,500. So as long as it's not breaking, you can see a lot of put writers forming that base 47,500. So they will definitely defend that level until and unless the resistances are not taking out, and Bank Nifty should also be heading towards higher levels of 48,700, 48,800.
Sure. Sony, so in terms of trading ideas, you have one on Granules and the other one on ITC. Can you take us through them?
Yes, definitely. So Granules pick is because Granules has it's just on a cusp of a fresh breakout. Above 406, 407, you can see a fresh breakout coming in Granules technically. Even derivatives data suggesting 400, 395 range is a very good support. I think risk reward is quite favorable right here, because if you see that, it's closed at 400 and 395, giving you that good support, it should be taken out the resistance of 406. The moment it does that, you see the breakout. So the advice is to buy 410 call option for December series. I think you can buy it in the range of 10 to 11 premium. You can keep a small stop loss of 4 rupees in premium and targets of 17 to 23. So the reason why 410 call option is chosen is because once the breakout is done, you would see that short covering, that fresh rally in Granules, which would take it to test towards 420-25 levels. So that's the first pick. And the second is ITC. ITC, we believe, is consolidating from 445 to 460, 465 levels. And the moment it's able to give that breakout above consolidation, it's just preparing itself to come out of that consolidation cocoon right now. So ITC is a very good pick over here. So it's the call option suggested is 470 call option. Premiums are quite low. You can buy it in the range of 2.5 to 3. Keep a stop loss of 1. And you can see it, doubling up to 7 to 8 points.
On Granules and ITC in terms of trading ideas for this morning. On that note, Sony, I'm going to take a moment to thank you for joining us and taking us through your views on the markets, as well as providing us with those trading ideas. And with that, handing it back over to you, Samina.
Thank you, Agam. That is the markets and what we're expecting in today's day of trade. The GIFT Nifty as well is indicating to flat to slightly positive start. One sector, though, that will be in focus is going to be IT. It has been in focus over the last couple of days since the Fed indicated that they would be looking, or rather their commentary was dovish. Well, we have with us Moshe Khatri, Managing Director of Wedbush Securities Equity Research, joining in. Moshe, it's an important morning, and I'm glad we got you today instead of yesterday, even though it'd be better if you were with us on Zoom. What are you making of Accenture? There is no growth in Accenture's consulting business. Discretionary deals are still not happening. What is their guidance going to mean for Indian IT firms?
Hey, good to be here, and apologies for having to reschedule. We're still suffering the result of power outages because of the storms here on the East Coast. So, Accenture's numbers are not a big surprise. We spent some time in India maybe a week and a half ago, and we did hear that in general, the large cap names continue to be relatively cautious about the near-term spending environment. The common word that we heard was hesitant, and it seems that the enterprises are still hesitant to spend on anything that's discretionary. We continue to see large deals that were won maybe 6 to 9 months ago with slower than usual conversion rates. And we're still probably 2-3 weeks away from the completion of the budget cycle, so you don't have a lot of visibility on that. So we're not really surprised to see Accenture's numbers. We're not really surprised to see Accenture's guidance for the February quarter, which was below our expectations. And I think in general, there's definitely a focus on the macro. And one of the things that we heard, and it's probably a good thing, is that enterprise clients are very focused or super focused on one main economic metric, which is interest rates. And there's a correlation with the intention to spend with moderating interest rates, i.e. the Fed's intent to stop raising rates. So, there's an expectation that this actually will bode well for discretionary spending down the road. But going back to what I said, Accenture's numbers are not surprising. These are typically, when they report their numbers for the November quarter, they're typically muted. And there isn't a lot of visibility into the next calendar year in terms of budgets, given where we are right now. So, again, pretty much in line with expectations.
Moshe, October to December, seasonally also is a weak quarter. You did mention that the word was caution, hesitant, and that is very obviously seen on the long-term deals or deal-making in that sense for the larger IT players. When do you think larger firms will begin to see an influx of long-term contracts? Are there any on the table right now?
So the deal flow, and when we talk of large deals, we're talking more about the cost takeout deals that have really become very popular, given the fact that many enterprises are going through some financial turmoil. So the deal flow is actually pretty strong, but the issue is more about conversion. We are hearing that we'll start. Enterprises are kind of telling vendors to start ramping. And I'm assuming you're going to start seeing that inflection point in the June quarter. March is typically weak, as you know, for the industry. And we believe that the December quarter will probably be impacted because of furloughs and because of the wage hike increases that at least two of the large names implemented during the December quarter.
Right, Moshe, I'm going to pull in two questions into one because I think we're running out of time. But very quickly, the rupee is set to get stronger. What is that going to do for margins of IT companies? Because one, you're hit on revenue, and then a stronger rupee is going to impact your margins. So it cannot be a good place to be in. Secondly, tier 2 companies are competing at a lower sort of margin. They're going for smaller deals. Puts them in a little bit of a tougher position than your large cap IT names are. How would you approach the difference between the tier 1 and tier 2 companies? I know you closely track the likes of an Infi, HCL Tech, and TCS, but just break that down for me. And also, a quick one, what are your thoughts on ER&D space? That is one space that looks pretty hot in India, at least.
Yeah, so a lot of questions and kind of bundled in one, right? So I would say a couple things. We've definitely seen a disparity in the commentary between the tier 1 kind of large cap names versus the smaller cap names. We visited a couple of smaller cap names that focus predominantly on digital, and they actually seem pretty bullish. Globant, EPAM, ThoughtWorks seem to be actually doing well. They've had some pretty aggressive recruiting plans in India, and that was in 2023, and that will repeat itself in 2024. But these companies also are a bit different. They're smaller. Each one has its own kind of story. Globant has an outsized exposure to Latin America. That continent is doing well. EPAM, it's more about their ability to build traction in India away from Eastern Europe. ThoughtWorks, it's more about their APAC division that's doing better after 18 months of really weakness. So that's really the big gap, and that's why I think the small cap names are doing pretty well. My biggest concern, and again, as you said, we're probably getting to the end of this session, is really expectations, Street's expectations for the group. And, I think the Street is probably a bit ahead of itself in terms of excitement about the next 6 to 12 months. and the street is forgetting that you do have some uncertainty, at least for the next few quarters. So it seems that expectations are a bit too aggressive for the space right now.
Right, thank you for that, Moshe Khatri there, setting the stage for what the Accenture numbers mean for the Indian IT pack as well. Thank you so much. Pleasure speaking with you. I mean, now welcome on the show Aditya Shah, founder, Hercules Advisor, and Kush Bora, founder, kushbora.com. Very good morning to both of you. Great to have you on the show, back on the show on India Market Open on NDTV Profit. Let me start with Kush Bora. So 2,500 was 21,500 was it touched and then receded fairly quickly. Is that where you're seeing the next sort of pain point come in, or much higher, Kush?
Hi, first up, a very good morning to you and all the viewers, and thank you for having me on the show. Well, the way I see it is that there's going to be a storm in a teacup. If you see the last few sessions, the indices have traded in a narrow range of about 100, 150 points, but then they've ended largely where they started. So I think, 21,600 on the upside and 21,200 on the downside is perhaps going to be the range, for the days to come. The markets might move a little higher, but there again, there'll be these swift and shallow rounds of profit booking that will come in. So I think on the whole, the bias remains positive. But given the low volumes, there could be some volatility, but the markets won't run away too much from here. But there won't be a bigger downside as well. So a storm in a teacup, I think, is the theme. Buy on dips remains the strategy for this market. And I think if there's any sort of topping out, that might just happen in January, as has been the case typically. So we do see the indices trade with a positive bias, and buy on dips would be our strategy.
What would be the strategy on the Bank Nifty, Kush?
Fairly similar. In fact, I think the Bank Nifty has a bit of catching up to do, but just for the last couple of days, the Bank Nifty seen a bit of a weakness, and perhaps the kind of news that we saw may not impact by much, but that there's some does sort of play psychologically. Also, if you see the Bank Nifty is making a lower high pattern for the last 2 to 3 sessions. Today's the weekly expiry where the 48,000 call option has a very strong base. So I'm guessing that for the near term, 48,400 is perhaps the Bank Nifty will head, and not too far from there. Again, on the downside, I don't see a very big downside here as well. 47,400 is perhaps the Bank Nifty should rest, and buy on dips continues to be our theme here as well.
Interesting. Okay, just before I go to Aditya, Kush, I don't know if we took stock ideas from you, but what are the stock calls for the morning?
There's a couple of them. Asian Paints looks good. I mean, definitely a beneficiary of the crude fall, but overall, if you see the setup very strong, the near-term movement has also been very encouraging, especially for the stock like, Asian Paints. From the near-term perspective, 34.20, 34.90 are the targets, and 32.90 is where I would place my stop loss. The second pick is from the defense space, Cochin Shipyard. The entire space has been doing well, and, we think this will continue to do well. Cochin Shipyard remains one of our top picks. 1340, 1370 are the targets. 1285 is where I would place my stop loss.
Okay. Well, Aditya Shah is also with us. Aditya, good having you. Just most people that I speak to, Aditya, are now saying that when it comes to the trading positions, I'm taking a lot of money on the leverage positions off the table because the markets seem a bit stretched. Let's wait for a pullback to put in the trading positions to work. But on the investment side, things are okay because earnings growth is going to compensate for the high valuations. Just trying to understand how you are thinking about it. Aditya, can you hear me?
Yes, I can hear you. So as much as I got the question, you were asking about the valuation side of it. So in my opinion, I feel that the bull run has just started. There can be intermittent corrections as such. But in my view, we are just getting started over the next 10 to 15 years over a strong bull run. Domestic facing economy continues to do extremely well. And with the election results, there's a very, very high possibility that the current government will come in and the decision making on the domestic economy side will continue to go on. So as such, valuations are not cheap. However, if you have a long-term time horizon of at least 5 to 7 years, I think you should continue to remain invested in the market. I think that India will be the bubble market of the next 10 years. Valuations will never be cheap in this market because everybody is chasing growth, and India is the only economy where growth is really very strong. So continue to stay invested. If you have your mutual fund SIPs, continue to invest in them and don't stop them just because the market is expensive.
Aditya, the buzzword seems to be defense. Almost everybody is talking about the quantum of order flow that has come in. And while the book to bill, even in the past, has been stronger, this time around the belief on execution is higher. My question is, are you going out and staying invested or putting fresh money to work in any of the defense names which have these significant order flows? I mean, BL is just a case in point. A clutch of others have gotten that, right? Where is it that you are sanguine in the defense space?
Niraj, unfortunately, we have taken money out of the defense sector because we feel that the valuations are extremely aggressive. Even though the order flow is really strong, we need to really understand that fundamentally the government has a fund crunch problem. And even though the defense order flow is really very strong, at some point in time, there will be a working capital challenge for all of these companies. Some of the stocks have moved up 10 to 15x. So in our opinion, it is a great time to take some money off the defense sector. However, we need to also understand indigenization of defense sector is something that is really big, and over the next 10 to 15 years, it is going to play out, be it in the drone sector, be it in the vessels or the ship sector, or be it in the gun sector. So in my view, the opportunity for over the next 10 to 15 years is extremely strong as the government pushes for Make in India. However, in the near term, the valuations are extremely stretched for all companies, and we have moved out knowingly from the defense sector, and we feel that valuations across other sectors could be compelling, that profit booking is required in the defense sector. So I want to caution everybody that don't buy these stocks at any valuation. There could be a problem going forward on the working capital side of it. Enough re-rating has already been done in the near term. There could be a time correction in all of these stocks.
And I think that's a valid way to think of it. Standard disclaimer, viewers, nobody knows what will happen, but this is a valid argument that I think Aditya is putting forth. The clutch of stocks and news, we'll talk about all of those. Remember, 3 or 4 stocks which might have either a block deal or a QIP open, so they might react. There is Varun Beverages, which we'll talk about. So all of that coming up on the other side of this very quick break. We also talk a very quick conversation with HP Singh, MD and Chairman at Satin Credit Care, post the QIP. Back with India Market Open right here on NDTV Profit. About a minute left for the markets to kickstart. And of course, a bunch of conversations. We've thus far spoken about levels, about stock ideas from Kush. And he's long on Cochin and Asian Paints, if I'm not wrong. And Aditya has said that be careful with defense. Now, we're going to talk about Varun Beverages. We're going to talk about Satin Credit Care. And we're going to talk about a clutch of stocks on which there are block deals happening. Actually, a quick 20-second answer, Aditya, if you can. Do you track embassy REITs at all? Fundamentally, are you constructive? There's a large block on offing. 20 seconds.
Yes, fundamentally very positive on the REIT sector and especially embassy REITs, given there's some bit of issue on the embassy side of it for the merger, but overall very positive on embassy REIT person.
Okay, thanks for that very short answer because we're just getting to the pre-open session. We'll talk about this in detail in just moments from now. But the pre-open rates, I don't know whether they'll show an uptick or no, but suffice to say, the GIFT Nifty implied open suggests that we'll have a good start. Let's wait and watch if we can build on from there. But here are the pre-open rates. I'll watch out for IT stocks in particular, simply because those are the names that came off a bit yesterday, and post Accenture, there might be merit in trying to see if there is more downtick in store or no. For now, the Nifty 50 almost seems to be going ahead, slightly higher than what the implied open also suggested. Let's give these rates a chance to settle down and then see where we are at. But FMCG, IT in particular, and some of the names which are going to see block trades, or maybe one or two block trades might have happened. We haven't got the flashes as yet, but it'll be interesting to see what happens there. But, you know, we've been talking, Tamanna, Samina and me have been talking about Varun Beverages, which is aiming to acquire 100% stake in a South Africa-based beverage company for 1,320 crore rupees. My colleague Mahima joins in to give us the details of this. Mahima.
Right,
Morning.
Niraj. Good morning. So as you rightly mentioned, the transaction is valued at 1,320 crore. The funding shall be done by an investment PE fund, and the remaining VBL will be raising debt for it. Now at present, if you see, VBL has approximately its footing in 10 nations in South Africa, and the BevCo has at present franchisee rights in SA, Lesotho and Eswatini, and the distribution rights for this are present in Nambia and Botswana. Now, if you see, BevCo at present has 5 manufacturing plants in South Africa. If you see the overall market of South Africa in terms of beverages, Coca-Cola holds a very big share, and at present BevCo has a share of only 10% in terms of volume. However, we've seen how Varun Beverages has performed in Zimbabwe and Nepal. So we're expecting that through this acquisition, PepsiCo will have a big market share in South Africa. And South Africa has one of the highest per capita consumption in terms of soft drinks. We had several brokerage reports also which came out today, and we saw that MK has said that post 70% run up in the stock in the past 52 weeks, they maintain a reduced rating with a target price of 1150. We also had CLSA on Varun Beverages, which has raised its rating to buy at a target price of 1419, and Jefferies also has rated it buy with a target price of 1100. And if we talk about stock performance, in the past 5 days it has run up 9%, and in the past 6 months it has run up 44%. So if you see in the FMCG space, yesterday Devyani announced its acquisition in Thailand, and today we have Varun Beverages, which is expanding its footing in South Africa. So overall, we're seeing that FMCGs are expanding in terms of geographical locations.
Thank you for that. You know, Varun Beverages definitely on everyone's watch list this morning. Aditya, let me come to you first. Brokerages are pretty positive. Jefferies has a buy with a 1100 target price. Motilal Oswal has a 1285 target price. Are you liking Varun right now?
Tamanna, Varun Beverages is a fantastic company. They find growth when people seem to think that the growth has topped out. And now this new expansion into the South African market bodes well for the company. So I am really positive from a business perspective on Varun Beverage. But right now the stock is extremely expensive. All good news have started to get priced into the stock. So any new entry right now into Varun Beverages is not advisable because the stock is extremely expensive. Any correction could be a great opportunity to add. But it's a fantastic business and a business that has shown ability to scale up time and again.
Yeah, look at that the Varun Beverages has already run up a fair bit. Just a quick word from Kush over there on Varun. on Varun Beverages?
I kind of agree with Aditya here. Fantastic stock, barely, we've seen it breach its, near-term moving averages. It's just that, on the weekly and the monthly setups, if we see, it's in the overheated territory. So I completely agree with Aditya here, is that, it's a great stock to add on declines. So if you get it anywhere closer to about 1100, which seems like quite a distant number now, given the opening. But if you get it somewhere in that range, of 1100, it'll be perhaps a good entry point. For now, the suggestion would be, if anyone's holding this position, book profit, take some money home and add more on declines.
Okay. Gentlemen, stay on. More to talk about, but a quick word from Mr. H.P. Singh. He's MD and Chairman of Satin Credit Care. Joins us right now on the show post their fundraise. Mr. Singh, thanks so much for being patient with us. Thanks for joining us today as well. A lot's happening. You are raising growth capital at a point of time when the central bank to everybody else is saying, hey, let's be cautious about the kind of lending that is happening in the space. The timing and more importantly, the growth targets that you've set for Satin for 2024.
I think the central bank is more, tuned towards restricting unsecured loans, which are kind of personal loans and for consumption, Microfinance loans typically are, they've been exempted from the risk weight category also. And these are, income generating and productive loans, and these are more focused towards the rural space. I think, over there is a lot of demand which is coming in terms of growth, in terms of the economic level of activity, which is probably on a rise. So I think, for us as well as for the entire sector, I think this momentum will continue for at least a few more years, which I can probably look at, in terms of the demand which is there. So I think, that is what exactly this QIP, which has been successfully being completed, was there for us.
Mr. Singh, good morning. This is Tamanna over here. Can we get a sense of for what purposes you're raising money? I know your QIP wants to raise about 300 crore rupees. What really is the growth outlook for which you are raising this money?
So we had given a guidance of 25% plus growth. We are in fact actually beating that guidance of ours. So it is for that growth, which we have raised our QIP. The QIP was for 250 crores. This has closed. We've got institutional investors, so the capital base also gets broadened a bit. We've got institutional investors like ICICI Prudential Life. We've got Bajaj Allianz Life. We've got Bandhan Mutual Fund. So looking at the cap table and looking at the growth which is probably being there, I think, this actually augurs very well, and it's a very big positive for the company also.
Let's talk about margins. Those have actually improved quite well. Your NIMs came in at 13.5% versus 12.1, 12.5 that you guided for. Credit cost has not eased in the system, and we saw a couple of the banks actually, hiking their MCLR very recently. How is credit cost playing out for you, and have you hiked rates in the last couple of weeks or months? And if not, is that on the anvil? Credit cost is expected to remain elevated. Just help us understand the landscape, because you lend in a very interesting space, and it's exciting to know what's happening in the non-microfinance space in that sense.
So if you really look at it, the microfinance space is, again, as I had said earlier, it's for income generating. There is a difference between income generating loans, productive loans, and the personal loans and the consumer loan space, which is there. Over here, the credit cost doesn't elevate as, compared to the other segment of personal loans. The reason being that this is required for businesses, and once businesses are able to generate profits as well as, the margins which are there, they are able to repay back easily across over there. So that's one a factor which is probably also looked at. In terms of the non-MFI space, again, if I talk about it, we've got two subsidiaries of ours, which does MSME lending as well as housing finance lending. And this is also focused towards rural. Now, once we actually look at the complete landscape of the rural economy as such, because of agriculture and other allied activities, the monsoon being normal, as well as the sowing and kharif crop, the acreage being normal across over there. I think, this is actually the reason why the portfolio quality also isn't going to deteriorate. In fact, I think if you really look at it, the credit costs are fairly under control even now and even going further ahead.
Mr. Singh, can you give us a sense of delinquencies, if any, recovery rates, because you're talking about the rural economy and the rural portfolio, where there isn't a very clear picture emerging on health of the rural economy right now. So what would be your take on this?
So if I give you our collection efficiency rates, which we actually look at it, our recovery rates are closer to about 99.5%, and that technical can tell you how the collection efficiency as well as delinquencies are panning out in the entire space as such. As to your point of that, there is no clear sign. I think, if you look at the demand in terms of credit, I think, that demand is pretty robust, But if you really look at, I'm not able to really say much on the FMCG product space in the rural side, I think, that is something which is probably very different from how we really look at the demand for credit in the rural space. So I think, over here, I think it's all positive. The delinquencies are under control. The growth is, the momentum is there. I think, this is all positives, which are probably coming in for us in the microfinance space as such.
Great having you, Mr. Singh. All the best for the quarters ahead with the growth rates as well. Thanks for speaking to us today.
Thank you.
Well, that's Satin Credit Care. Very comfortable about the growth numbers. Aditya, come in here. Satin or some of these mid-sized NBFCs and the kind of growth targets that they've set for themselves, investable, or are there better pockets?
One thing fundamentally about the MFI space is that MFI space is super cyclical in nature. When the going is really very good, you can make a lot of money, but when going is really bad, you can lose a lot of money. So right now, as you know, there's a huge credit upcycle going on in the economy. NPAs are really low, credit growth is very strong, and now companies are able to raise capital at a good pace. So in my opinion, this is the perfect time to exit out of the party in the MFI space, because there's going to be some event or the other in the coming year or in the year after that, where the MFI space is going to get really hit, and the stocks are not really cheap. Some of them are trading at about 3 to 4 times price to book. So in my opinion, rather than going into the MFI space, one could really look at the large private sector banks, where the valuations are still relevant with respect to their historical valuation. So avoid for the MFI space. As a disclosure, we have exited all positions in the MFI space.
That's quite clear over there. Look at the opening that we're setting up for, and that's just fantastic. Pre-open rates have settled. You're opening at a robust 21,543. So you're definitely opening above 21,500 mark. That strength being seen over there. Just a quick call, Kush, if any, before we start trade. We have about 3 odd minutes to go. What is your key strategy, top picks right now?
One stock from the cash segment that's looking good is NLC India. That's something that we've got on our radar for a while. So, that's a stock that, even the viewers can have on their radar. On the upside, 225 and 245 are the targets that we're looking at positionally. And a stop loss would be at 195. So NLC India looks good, from a positional perspective.
Nestle, after the big move yesterday on Nestle and Coal India, are you expecting the rally to continue? And if anybody initiated longs yesterday, how much further do you think the rally could play out today?
That question is for me?
Yes.
Sure. Well, again, Nestle has actually not done quite as well as some of the other peers. But yesterday, the move that we saw was fantastic. Volume-backed breakout, and 25,100, 200 was a resistance zone, so it's actually closed above that. So I suppose this rally could continue. And on the upside, the numbers that we're looking at are 26,200 as the first target, and then 26,800. So I will stay invested. As you said, if anyone's got a position, what do? My suggestion: put a trailing stop loss of your buying price and just ride the wave. 24,800 is a good support zone. As far as Coal India goes, actually, interestingly, the structure is very similar here as well, as compared to Nestle. The stock was languishing and consolidating for about 8 to 10 sessions, and a very clear volume-backed breakout here. So continue to hold on to this as well. Place your trailing stop loss close to 360. 385 and then about 399 is where I would have this stock head to, or rather see this stock head to in the next couple of sessions. And on the downside, as I said, 360, 355 is a strong support zone. Keep your trailing stop losses, ride the momentum in both of these.
Kush, Hindustan Copper in the last half an hour saw a pretty sharp rally play out. Today, of course, there's some news on the counter as well. How do you approach Hindustan Copper? If you do get a flat start, would you consider going long?
Not really. The stock's actually, very clearly in overbought territory. However, what is encouraging is the fact that even despite this kind of move, there are volume-backed, up moves, but the risk-reward ratio is not favorable. So, no fresh entries. Ride the existing position with a trailing stop loss. That would be around, close to 206, 220 is where I would, have my first target.
Okay. Kush, can you give us your top call for the morning? Very quickly, sure. 10, 20 seconds. Top call, one top call.
Cochin Shipyard is where I would place my money. 1340, 1370 targets, 1285 as my stop loss.
Okay, can we just bring up Cochin Shipyard here? He's given his targets, of course, but let's see what the pre-open rates are opening for Cochin Shipyard before we get to the market open as well. But I believe Cochin Shipyard too would have started off higher. Okay, let's wait for the market to open, and then we'll show Cochin Shipyard. We'll revisit whether somebody can enter into Cochin Shipyard once the market open is done. But here are the first rates this Wednesday morning. On the Nifty, about 0.4%, 89 odd points. So not bad, pretty much in line with what was anticipated. The Sensex too about a 0.4% uptick, and the Nifty Bank is about 1/3%. I'm interested in Nifty IT, if we can pull that one up and just see whether that index is pulling back a bit. No, not really. Okay, so let's get the heat map up on the screen before we get to the mid caps and the small caps, because IT is actually doing really well, much contrary to what Accenture commentary suggested. Nifty IT is having a good start. Tech Mahindra, Wipro, LTI, all three in the green. So good start for the IT biggies. NTPC is the other one which is up about 1%. Nestle, Samina was talking about it. It continues from where it left off yesterday, 0.7 or 0.8% up for that one. And not too many losers, save for Maruti, which is also on the brink of coming into the green. We have all other 49 stocks in the Nifty trading in the green, and Maruti too just about moving there. So you can safely say that we have all 50 Nifty stocks trading in the green, with IT ruling the roost, but the others not far behind. Adani Ports is up about 1% too. I don't see Adani Enterprises, usually they move in tandem, but Adani Ports is certainly up. Big boy Reliance is up another 0.5% after having a decent outing yesterday. But seems to be an IT day, Tamanna. Wipro, LTI, Infi, Tech Mahindra, all of them trading in the green.
Absolutely, and IT has had an amazing rebound since yesterday. I mean, just look at this chart. It's a sea of green this morning. So you had this AIF news, no impact at all. Accenture, not too great numbers, no impact at all. So this is a very different kind of a market that we're looking at. But let's get stock specific. The hero of the morning is Varun Beverages. No prizes for guessing that. A slew of very positive notes after the news coming in that they're acquiring South Africa's the beverage company. So Varun is up about 15% in opening trade and gaining smartly. So that's one to keep an eye out on. I would also add Ashok Leyland. Ashok Leyland also tepid over there, but there was a CLSA report on it maintaining a buy with price target of 238 for Ashok Leyland. Embassy Office Parks REIT will be another one which we should see what's happening there, and Blackstone is selling its entire 23.5% stake. We talked about it in your trade setup, and you're seeing the impact over there. The stock about 3% down. More in stake sales with Nippon Life India AMC. IndusInd Bank is selling about a 2.86% stake. That stock up about nearly 7%. That's a block deal which has gone through, and the floor price was 426. That stock rising smartly. I'm just going to put SpiceJet on that list as well because of the never-ending news flow. And the newest one is the details of who these knights in shining armor are, throwing a lifeline to SpiceJet in terms of a 1,100 crore rupee fund infusion. This is as per a newspaper report this morning. Mr. and Mrs. Mahapatra, Harihara and Preeti Mahapatra, are investing 1,100 crores in SpiceJet for a 19% stake. So now we have some clue to the question we've been asking, how SpiceJet is planning to buy Go First. Glenmark Life Sciences. Let's look at Glenmark Life Sciences as well and see what's happening over there as far as Glenmark is concerned. concern. Glenmark at 0.45% up this morning, so not too much of an impact. The CCI has approved the acquisition of its majority stake by Nirma on expected lines. NTPC and just Jubilant, two other stocks on my list. The NTPC has achieved its fastest 300 billion unit of power production. Energy has anyway been doing very, very well. And Jubilant Foodworks, the company's unit, has launched a cash offer for its remaining 43% stake in DP Eurasia. Just Cochin was the last one since, Kush talked about it just as we went into trade as his big idea for the day. And it's not too bad at 1% up. So, Samina, looking like an interesting morning and definitely a buoyant morning.
It is a good morning, to say the least. Lots of stocks in the green. The breadth of the market is also pretty solid, and I think that's what bulls will be taking heart from. We talked about Varun Beverages. Devyani as well had a pretty solid run yesterday, and the rally continues on. Varun Beverages is off the day's high point. Devyani, though, building onto those gains from yesterday, gained another 2%. Oil and gas stocks should be in focus on back of the way crude is moving. BPCL, HPCL, IOC are not really reacting to higher crude prices. Stocks like OIL are trading with a gain of 3%. Fertilizer companies, so Deepak Nitrate, this stock did see quite a heavy long built up in the F&O market yesterday, so all your fertilizer names actually not doing too bad in trade. Voltas, Delivery, IRFC are some of the other names that are having a rather pleasant morning. Well, that is what the markets are looking like. You've got two listings in the next couple of minutes, DOMS and India Shelter Finance. The street will be watching out for these ones. DOM, of course, had a very euphoric participation coming from investors, so expect a stellar debut to say the least, and the broader market sentiment also is quite supportive, so both those things should help DOM and India Shelter Finance, which we'll list very shortly. Well, Aditya, I want to come to you, and I spoke to Kush about Nestle, but I didn't get a chance to discuss that with you. What is your take on Nestle? It's looking like it's in a sweet spot. Of course, the stock hasn't participated in the recent couple of months, the recent rally. Are you constructive on Nestle right now?
So net, our view on FMCG businesses is really positive. Nestle is a super brand with some high quality products in their portfolio. Of course, there's no need to say that the stock is expensive. The stock will continue to remain expensive. So anybody who's got a 3 to 5 year time horizon, only they should invest in the stock, because there's a possibility of a near-term time correction in the stock. Per se, on the FMCG side of it, we've talked about Varun Beverage, we have talked about Devyani, we have talked about a lot of companies where consumption per se in India is really growing. So that's a theme that people need to really concentrate on. And within those stocks, Nestle is also a stock that we are really positive on.
Okay. Wondering, Aditya, the IT names, we've seen a very strong up move in the last few days, but nothing in Accenture's commentary suggested otherwise. Most brokerages have come out with calls in the last 1 month have been negative. What's changed? I mean, are you investing here?
So what has changed, Niraj, really is that IT stocks will tend to discount the future order flow much before the order flows really come in. And that's what is really happening. The commentary from the US Fed suggested that they are getting ready for an interest rate cut cycle maybe in the second half of next year. And that's what the market is really betting on, that maybe somewhere in the second half of 24, the interest rate cut cycle will begin and the slowdown in the US will start to get arrested. So in the near term, the commentary and the order flow will really be negative, as Moshe was also saying, and we can already see in the Accenture numbers. But fundamentally, from a strategy perspective, the market is pricing in a recovery in 24. We are long on selective IT names. They have been part of our portfolio all through this down cycle, and they continue to remain so. We are very constructive on mid-cap IT names. And as Tamanna was also saying, the ER&D space continues to remain very, very lucrative for us. So we are long here, but we also know that over the next 6 months to 1 year, there are very little returns to be made here. But after that, there could be a huge recovery in the sector as the order flow starts to come in. So slow and steady positions is what needs to be made today in the IT sector.
Wow, and the IT sector is definitely not slow and steady in trade today, already up about a percentage point. I just want to talk very quickly about what the RBI has done and said last evening, and pull up Piramal Enterprises and IIFL. Piramal Enterprises not doing too well, though IIFL is tepid, but lower down. Pyramid Enterprises about 3.5% down. Aditya, I'm going to come back to you on impact, if any. Now, the entire story is hinting at a possible problem. How deep, how wide, and how many could be impacted is not clear yet. What is your take? Is this an issue going to be restricted to NBFCs? Any sense on who's on the other end in terms of borrowers who are looking like they're in need of this so-called evergreening?
So, the regulator of the year has to be the Reserve Bank of India. It has come down and cracked on a lot of misgivings that are happening within the lending space. And now it has come out on the evergreening of loans that these lenders continue to keep doing through the AIF route. In my opinion, all these NBFCs, the smaller NBFCs where there has always been a problem of evergreening, are the ones who are going to get really hit. And we're already seeing some of the lenders, they are getting hit today because of this RBI circular. So the broader perspective is, even though there can be a short-term correction, but the system is getting cleaned up, and the RBI is very mindful of the unsecured loans, of the evergreening of loans that some of these NBFCs are really doing. So small finance banks are really safe from this because they already had a mechanism where they could not invest in the AIFs. NBFCs are the ones who are specially hit. The smaller NBFCs who window dressed loans are the ones who are going to get hit. So you need to be very careful if you start to take position in the smaller NBFCs. The clear winners will be the bigger NBFCs like Bajaj Finance and the small finance banks where the market share will start to move away.
Industries. Kush, what are you doing with RIL?
Oh, very clearly a buyer here. It's just that it might just perhaps take a pause, year end, and it's already seen quite a bit of a move. But on the whole, have been bullish for a while now on Reliance Industries, and it's starting to pay rich dividends. No pun intended. But on the whole, still bullish. I think this momentum could continue. Perhaps we could see the stock pause a little, for the next couple of weeks or so. There'll be a resistance around the 2600 level, plus there'll be some call base as well. The monthly call base will also start acting up. But other than that, I don't see this stock, stopping anytime soon. It's not typically a trader counter, but then the way it's behaved in the last few sessions, it might just continue to, surprise on the positive side. So on the upside, we're looking at targets of 2750, and once that is taken out, I think 2825 is the level that we're looking for. Overall, bullish. Keep adding this. If you're an investor already invested in this, ride the momentum.
Right, that's the call coming in. Thank you, Aditya and Kush, for joining us this morning. It's a good day of trade. The markets are holding up. The broader markets are looking good. Couple of big movers apart, getting beyond the large cap names as stocks like Persistent, LTS, SAIL, Idea. You've got Voltas, the big rally of 4.5%. Devyani is looking good. Varun Beverage is still holding steady with a gain of 15-odd%. Very few losers, and I think that's what bulls will be taking heart from today. It very evidently seems to be a rally without any sort of pauses. We'll take a break, but we have a very special guest on the other side. CEO and MD of Symphony joins in for an exclusive chat with us.
Right, back with India Market Open right here on NDTV Profit. Let's take a look at the top headlines at this hour. First, it's a wonderful Wednesday on the Lal Street as markets open at a fresh record high. Nifty above 21,500, Sensex over 71,800 mark. Broader markets outperform. All sectoral indices paint a fresh coat of green, pulled higher by the IT index. FMCG, media, oil and gas, metals and real estate follow. Varun Beverages pops over 18%. Stock hits all-time highs on acquisition of South African company Bevco. Stationery maker Doms and India Shelter to make the Lal Street debut today after record subscriptions. An RBI cracks down on misuse of alternative investment funds. Funds worth 20,000 crores will be hit. Well, it's the end of the year and we should get in some of entrepreneurs, promoters, chairmen and MDs to talk about what do they anticipate 2024 to be like. It's a great time as any to get in Mr. Achal Bakeri, Chairman and Managing Director of Symphony, who joins us right now on the show. Mr. Bakeri, good having you. Thanks so much for taking the time out. Hope all is well. And reflecting back upon 2023, how do you feel the year went by? What's the sense about FY24 or 2024?
23 was a mixed bag. We've had, not so great business in India and in Australia. We had a phenomenal summer and good business in Mexico. China was okay. So it's been a mixed bag. But 24, at least the financial year 24-25 promises to be a lot better. And we are very positive, very, very upbeat about the prospects. And, we've got with our plans sort of in place for a bumper summer and growth in all the other markets that we operate in.
Announcements about you putting in some money, additional money, if I'm not wrong, into the Australia business as well. Now, give us a sense of the consolidated Symphony and stripping out of India business. We'll come to India in a bit. About the non-India businesses.
Right. So about the non-India businesses, like I said, yes, Australia has been a bit of a dark spot, in our business in the last couple of years. But the worst is now sort of behind us. And, from 2024-25, all our plans that we had put in place would begin to bear fruit. The entire transformation of the business that we had initiated would be sort of, executed by the end of the current year, and it will begin to bear fruit from 24-25. So the extra money that we have infused, equity that we have infused, is more to retire some debt. And net, I mean, it is not really, additional sort of capital that is being infused into the business. It's just the nature of the money that's going in.
Mr. Bakeri, a lot of businesses which go through cycles and cooling solutions because of the weather vagaries at times go through cycles as well. But the great time to look at businesses afresh, both from a promoter's perspective and an investor's perspective, is at the lower end of the cycle. Now, I'm trying to understand if you think of these businesses as one such, because now there's a global piece attached to it. And therefore, just looking at the past 3 years, wherein revenues have largely been stable, but not shown a bump up, would you believe that you've kind of you've seen a bit of a bottoming out of the cycle, and could there be upsides? And if so, what could the reasons be?
So we actually believe that we've hit the bottom of the trough. The trough was largely caused due to COVID and the after effects of COVID. It might appear that, people are using COVID as a crutch for far too long. But the fact is that, all our sort of input costs, which had been elevated, haven't come down to pre-COVID levels. Economies have been impacted, whether in Australia or in China. So it certainly has had its impact. And, all the transformation projects that we had set into motion before COVID, especially in Australia, were impacted because of COVID. And they are now beginning to sort of, like I said before, now beginning to fall in place. So we I do believe that we are at the bottom of the trough, and things can only get better from here onwards.
Okay. So the things will get better simply because of the fact that you sense, in your understanding, demand at the global level to be picking up in the countries that you are present in, because you are largely, arguably, amongst the largest air cooler players worldwide and not just in India.
So combination of factors, both external and internal. Externally, what happens to in terms of the weather is difficult to predict, but it's certainly in terms of the economy, and especially the Australian economy, which was badly impacted, is beginning to looking up. A lot of our business is with the real estate sector. The real estate sector in Australia had been badly impacted, so that is beginning to look up. China too, where a lot of our business is B2B, has been impacted in the last few years, but we've already beginning to see signs of improvement in our business in China. So to some extent, it's a lot of these external factors, and internally too, like I said, all the value engineering projects, the transformation projects that we had put into motion are now falling in place and will begin to bear fruit. So it reminds me of a similar situation several years ago when we, just after the global financial crisis, when we had acquired our subsidiary in Mexico. We had a similar situation, where we were for a few years, things did not look good, and once the entire transformation in Mexico sort of fell into place, it became debt-free, it became an asset-light, capital-light company, and it's been a profitable company ever since. Although it's, in terms of absolute top line and bottom line, it's not much, it's not a significant component of the overall Symphony business, but nonetheless, the point is that it is sort of cruising on its own, and we believe that the Australian subsidiary too should be in that status going forward.
Mr. Bakeri, very good morning. This is Tamanna Inamdar here. I have a sort of broader view question for you, and this is a story we reported on NDTVProfit.com that the DPIIT is holding an industry workshop. The government is figuring out a plan to manufacture more efficient air conditioners, but also cooling solutions to help India deal with climate change. Now, all forecasts tell us this is going to be a huge issue. Right now, cooling solutions and air conditioners specifically are restricted in usage to a small proportion of the population. As we move ahead, more and more people are going to need this to survive, not just as a luxury. I just want to get your idea on this and how Symphony is thinking in this direction, where cooling solutions is going to become a mass survival product.
Absolutely, and more so air coolers because of its, their low energy consumption, and because of their, plug and play ability to be a plug and play product and portable product, and also in the space of industrial cooling, where you have these large 99% of the factories and warehouses in the country do not have any form of cooling, and they are unbearable to work in come summer. And air cooling is probably the only feasible solution. You can't air condition large factories and warehouses where you have machines and lots of people working, and high ceilings, and and these are not contained spaces. So an air cooling solution is actually the best suited for that. And we believe, and we've been working on industrial air cooling for the last several years, and spreading the mantra, the concept of industrial air cooling. And we believe that too, as a concept, will take root and will proliferate as it has in many parts of the world, including in China, where especially in southern China, where it's hot, every factory is air cooled. So we believe that that is a sort of a situation which should also happen in India. And as far as homes go too, the people's threshold of comfort is fairly low now, in terms of temperature. So we have to provide, or rather, the expectations of of a good night's sleep exists across all sections of society. So an air cooler is something which helps in democratizing comfort, and we believe that going forward, along with air conditioners and fans and all cooling devices, the future is huge, and the penetration levels in our country are so low for every product category that you can only go up from here.
That's true, absolutely, in a broader term. But I was trying to understand, Mr. Bakeri, in terms of strategy and goals. Where are you at in devising such devices or more market penetration, where the efficiency of these systems are better, so that people don't have to all go in for air conditioners, or where there can be more market penetration?
So there are two parts to your question. One is about the product and what are we doing to proliferate the concept. So in terms of the product per se is inherently quite efficient, but nonetheless, at the technological level, we keep on working on making the product more and more efficient year in, year out. Secondly, we have been expanding our distribution reach all these years, and that is something which we can keep on doing in a country as vast as India. We can keep on doing forever. So that is also something which we are working on, to bring the product to people across the country. So I think we are working on these two things, making the product better and more efficient, and making it accessible across the country.
Mr. Bakeri, some numbers, March 2020, and you've told this to me in the past, that the last 2-3 years, due to various reasons, growth hasn't been greatest. I'm just putting numbers out here. March 2020 sales were about 1103 crores, if I'm not wrong. They've come in at 1188 or 1190 crores as of March 2023. TTM sales around that level. So no growth, but no downticks either. In terms of numbers, if you expect, because of internal and external reasons, that business will look up, are there some targets that you're setting for yourself internally about where do you want to see Symphony's size to be like, say, 3-4 years, 5 years out?
Certainly, Niraj. So we surely have a roadmap going forward. We have internal targets, and we expect to be a much larger company than we are today. Like I said, we've plateaued for a while, but this is the bottom of the trough, and we do expect, significant growth going forward, and to be a much bigger company than we are today. Now, I wouldn't give exact numbers or what our internal plans are, but I can safely say that our plans are certainly, and they are not pies in the sky. They are sort of, what we believe are quite achievable numbers, and so the team is sort of working towards that.
Would these be accompanied, Mr. Bakeri, with better ROE, ROCs? Because you used to enjoy tremendous return ratios in your standalone India business. I presume that would still be the case. Consol numbers look a bit off simply because of the nature of the business globally versus India. But because we look at the Consol entity now for the reported numbers, do you reckon that in the next 3-4 years, there's a fighting chance that your return ratios will look much better than what they are right now, even if they don't look as good as the India business?
You said it right. They will never look as good as the India business on a standalone basis, but they'll certainly look a lot better than they do today. The India business too, on a standalone basis, doesn't look as good as it did, let's say, 5 years ago, 4 years ago. But they too will begin to look better going forward. So in every respect, in every which way, we believe that this is the bottom of the trough.
Got it. Just trying to understand, Mr. Bakeri, my final question really, and I know you won't need too many funds, so I don't think fundraising is a question. But my only question is, would you believe that when you're talking about the trough and things looking better, are we talking about a significant better in the return ratios or growth rates, or is it a slow a steady move upwards over the course of the next 3-4 years?
Niraj, I would refrain from, specifying the kind of growth that we would, because that has been, we have not very long ago, actually framed, a policy for this, for sort of guidance. And it's, I don't want to get into the entire area of guidance, but we believe that we will certainly look a lot better than we are today.
Okay. Well, we wish you all the best for that, Mr. Bakeri. Thank you so much for taking the time out and speaking to us on NDTV Profit. It's the period of our launch, and it's very special to have you.
Pleasure is all mine. Thank you for having me.
No, pleasure is ours. Well, just maybe not the right season to talk to a cooling solutions company, but just the fact that 2023 is, not been the best of years. Can this be the turn of a cycle? A few people believe so.
We are in El Nino. We are in El Nino, which it's a fact. So you're going to have a hotter winter than ever before. And this is something that we're seeing the world over. Cooling solutions when it comes to climate change and to keep your emissions low is the only way going forward. If you're going to hit very murderous high degrees of temperature, you're going to have to keep people safe, and you need cheaper, more efficient cooling solutions. So in a long-term way, that's definitely a company and a space to watch out for.
Yeah, well, and a few people tell me that, so pertinent to talk to him today as well. Well, that's Symphony. Take a break. But what about markets at large? Vinay Jaising of JM Financial Services joins in on the other side of this break to talk about markets and more. back with India Market Open right here on NDTV Profit. Pull up the markets for a brief bit and just see what we're up to. So the Nifty in the session today started off about 0.4% higher, currently trading in or around the high point of the day. So good going really. And a clutch of stocks have done very well. Warren Beverage is the case in point, but a bunch of others too. The new listings, the pre-open rates as they've settled seem to suggest that the listings will be strong for DOMS in particular. Let's see if there is more in store. But good time to get in Vinay Jaising, MD of PMS at JM Financial Services, for his thoughts on what's happening currently in the markets and what's the way ahead. Vinay, been a while. Thanks so much for taking the time out. Niraj here. Good morning.
Good morning, Niraj.
What's the thought, Vinay? I mean, the markets seem to have caught not just the bears, but even the bulls by surprise. The question is, can this move or can this exuberance continue well into the earnings season, or is there a case and a valid case for there to be a pullback?
So let's break this question up into a technical case and let's break it up into an earnings momentum run case. So on the technical case, it makes a very good long-term story for India because number one, the FII ownership is at probably a 10-year low for India. It's up 17%. Say if you put maths for a $4 trillion market cap country, you're adding about 3% to go to the number of 20, if we believe 20 is where FIIs want to be there. And that's, somewhere close to $120 billion of inflows coming in. Come June, you have the JPEM index, so bond funds also would come in off about $20 to $25 billion. So I think post-election, you're going to see a lot of catch-up impact of inflows coming on FIIs, be it on the debt market or equity market. The last month itself saw, close to $5 billion of inflows come in, and the previous month was 2.5. So that's FII inflows. Now, if you look at SIP inflows, that's a solid $2 billion plus a month, and about 30% more comes in from pension funds. So there's a lot of inflows coming in, which India has never seen. So that's, the technical point tells you that, the market's looking robust. Any correction, you should look at buying. So that's step one. Step two, if I look at earnings momentum, as far as India is concerned, earlier the legs of earnings were coming only in the financial sector. That was 30% of the overall index, and that was growing, at a very, very impressive rate of about 30 to 35% post-COVID, because provisions, were getting cut down. So even if the loan book growth was 12 to 15%, you had a very strong growth at the profit level. But now what you're seeing is companies in the Capex sector, companies in, I think every other space but energy and IT, which are probably going to go back to where they were growing earlier. Most of the other spaces, the earnings growth trajectory is a lot more higher. So you're looking at north of 15% growth for the next 2-3 years, and that number, I think, will keep on getting inched up. So earnings is going India's way. Technical analysis going India's way, but mind you, what's not going to go the global way is the geopolitical risk, I think, which is very high. And, one of the things we went very wrong last year, we felt the world would have a recession in 2023, but the GDP grew a lot more than expected. And the pain point of that, globally would come in the first half of this year, especially, till they don't cut down the interest rates, the high for long interest rate regime, which has already existed for the last 15 to 20 months, will start slowing down the global economy. And there is, I think, a tougher year for overall world GDP. As compared to 23-24 will be a much tougher year. So the overall global ambience in the first half especially may not be interesting. Second half, you'll see interest rates come down and people will be smiling again. Sorry, but long answer for your question.
Well, that's okay, Vinay. And it's good to get these long answers as well. The question, though, is around earnings. And Vinay, I heard your point. The thing is that it's almost a trending year, yes, and therefore there is a validity to an argument that some people are making that earnings might surprise in quarter 3, arguably quarter 4 as well. But we know the world growth is slowing down. At that point of time, are we seeing at FY25 being a year wherein earnings might hold a case for disappointment because the external facing sectors will have a real issue when it comes to earnings delivery?
absolutely. So if I was you, and that's what we're doing for our fund, and same thing we're telling investors, look a lot more domestic, look a lot less global, look a lot more on Make in India stories, which are probably giving way for what was coming into the rest of the country from, the rest of the world. So let's say defense, if you are buying from the rest of the world earlier, today we are producing it internally. So that's a Make in India story. The defense budgets, not just in India, globally are going up. So look a lot at spaces where you depend internally for your demand. If you're looking at Capex, that's a function of the Indian budget. Corporates have still to, tick the box. So I agree with you totally. Domestic story will just increase in the year fiscal 25 compared to the year fiscal 24 for equity investments, for you to get a healthy equity investment return. Having said that, what's also happening, and, I'm just taking case in point, let's say for the IT sector, which depends a lot as far as US is concerned, and there could be a global slowdown in the first half of the year. But think of it this way, right? The IT sector, you break it up again into two baskets. First basket is the large IT companies, which depend on virtually the US economy. And the second is the R&D companies, which are pseudo manufacturing and pseudo R&D companies. They're small. The way these companies, and there are many good quality companies, be it Cyient, be it Axis CAD, be it Tata Technology, all these names, are getting orders from the rest of the world in the space they are good in, which is increasing, be it in airlines, be it in defense. So you could see even global facing sectors as one-offs doing really well, purely because India is becoming a China plus one play. My concern really, Niraj, is more so on if there is a global slowdown in the first year half. Would there be outflows before elections, and then once interest rates come down, isn't 2024 going to be a tale of two stories? The first quarter wherein you'll see pain, and then the next 9 months wherein as interest rates go down, every economist and strategist will remind you when interest goes down, it's good time to increase the intrinsic value of companies, and this is where the market should go up. So, you'll see two paths, I think, in next year.
Vinay, stay on with us. Vinay Jaising here weighing in on where the markets are headed. But meanwhile, I just want to quickly show you two pictures on your screens right now. These are two new listings which we're going to be seeing in just about 30 seconds from now. One is DOMS Industries, the other is India Shelter Finance Corp. And both looking like, as of now, that they might give their investors or whoever got those allotments a decent listing pop. Now, this has definitely been the flavor of the season, or I would say the flavor of the year, and I'm going to come in just a bit when we see how those companies list. We're going to come and just ask Vinay his views, and I mean $1,400 on DOMS. It was a 790 rupee issue price. You're seeing on India Shelter Finance Corp as well, a very good pop actually. You're seeing a 16-17% listing gain, and that will perhaps pare down. But it's telling you the nature of the way money is being raised in this market, and those who get in on allotment are also being rewarded. How it settles remains to be seen. I was just taking a look at Flair Writing because it was a previous issue and also in the same space as DOMS Stationery Maker, and that's not doing too badly as well compared to listing prices. So we'll keep tracking those stories. But Vinay, hi, Tamanna here, and I just wanted to get your sense of what is happening in the primary market. Now, those who are slightly skeptical might say that in this rush for money to find a residence, you might have kind of fundraising which doesn't deserve the attention it's getting, whether it's IPOs or QIPs. Do you think that concern is there, or do you think that you're seeing the right value right now for solid companies?
So, the statement is price is always king, that rules the roster. Having said that, even at the price at which IPO is coming, as you can see in the screen which you showed, the stocks are moving a lot higher in the shorter term. So we got to take case in point of companies. We can't make a generic statement. Having said that, let's look at a couple of names, which have come out in the shorter term. Be it companies like Concord Biotech, be it companies like Blue Jet. What you've seen is quality of IPOs which are in, or even Tata Technology, the quality of IPOs coming in are far better quality as far as balance sheet is concerned, as far as their earnings trajectory is concerned, than what was earlier. Both the breadth and depth of the market are very impressive for the new IPOs coming in. And that, I think, is giving a lot of feel-good factor to an investor. As against, you're coming to the market because you desperately need to change your debt burden, your costs of capital are too high, and you're using equity in a wrong way in the shorter term to replace that. What you're seeing really is nice names, good earnings trajectory. So focus really on not what's coming out or what you're buying based on, what you're hearing, but focus on, going back to your balance sheets, because this is the time for valuations being, clearly much higher than what one would have expected if you were starting the year. So focus on quality balance sheets, focus on earnings, high return on capital employed, and you'll get a lot of names. But as bottom-up ideas, you can't make a generic comment, unfortunately.
Enough. Which is why let's get to the specifics on how you pick those bottom-up ideas and what is looking interesting right now. It becomes a tougher and tougher call, doesn't it, Vinay? With that much excitement and funds flowing in, and then the responsibility or the expectations of generating those kind of returns. So is there any space that you're particularly seeing with that kind of an upside potential?
Sure. Let's break the space up into three. The first space is Capex, the second space is Make in India, and the third space is consumption. I would have normally gone the other way around, but because, the time of the market is such that people are questioning mid and small cap ideas a lot, and should we be invested, should we go out? That's the question which is in everyone's minds, because if you look at the year 2023, the small and mid cap space is up almost 40%. It's like the Nasdaq, and these are the two best performing spaces for any investor in the world. So when we look at the Capex space, what are we getting a feel good from? The first is the government increasing the Capex, be it in rail, be it in road, be it in defense, be it in water treatment. Now, if you come to this space and we're talking about increased Capex, which is 5 to 6 times in the last 10 years, some of them, like in the water treatment part, have Capex increased as much as 7 to 8 times. Some of them in the defense field have Capex increased in 9 to 10 times. Road is 12 times. You know how much time it takes you to reach, from your home to your office. You can see the amount of construction work which is going on, and that's all over India. So that space is something which we are excited about. But here, you have those companies which are at very, very high valuations, which is 50, 60, 70. And then, though their ROCEs are pretty impressive, they may be a sourcing hub of India. Last year, these were a place. Now what we're looking at a lot more are companies which are doing good on technology. They have a ROCE of maybe 15%, but their earnings growth trajectory is 25 to 30%. What's important is their balance sheet is either net cash or rock solid, far better. Their cash conversion ratios are positive, as against them just keeping on increasing their overall balance sheet size, because they need to be taking loans for the revenues which they are getting in. Those kind of companies, I think, would do a lot better in the next years, because Capex is one thing which India will keep on increasing. Remember, we are the most populous country in the world, and being the most populous nation in the world, you need to have workforce coming in, and I think that's the single biggest agenda for this government and any government to take care of. So I think tick the box on Capex. You've not seen corporate Capex take up, so that gives us even more excitement, because today all the load or the burden of Capex is being borne by the Indian government. As you start seeing Capex take up a lot more, you will start seeing a lot more visibility of shorter term projects also come up, and you will see more ideas come up. So that's the first story, Capex. The second, Make in India, and going back to Niraj's question, as I did say, look domestic, but where you have an edge, be it in the chemical field, be it in the production field, contract manufacturing field, be it in pharmaceuticals or in products like defense, where India is probably replacing China, where it has the DNA to do so. I think that's a field we are looking at in a very, very big way. The third field is, the erstwhile finance and consumption consumption put together, be it in drinks or be it in the QSR chain, or be it, purely in, how, today with real estate being the need of the hour for people and rates not having moved up so much, and interest rates in India, 5 to 10 years ago were much higher than what today. We won't be surprised if you start seeing, volume growth in the real estate market happen, especially for affordable housing. So it's good to look at, the associate spaces linked up to affordable housing, be it finance companies or be it purely, companies which are going to give products to these finance companies, the building material companies. So there's a big space I think you can look at, but it's all about bottom-up picking. Let's not be very general. That's a comment we want to leave behind as well.
Vinay, I don't know how specific you can get, but let's talk about the last theme that you mentioned, real estate, right? Now, how are you going about choosing which sphere to bet on, whether it's ancillaries or pure play real estate companies, and within that too, which companies, if at all, come to mind, because there are pan-India players, there are South India players who are probably doing much better on the volume front, but it's not that volumes are missing in MMR or NCR region either.
So I think we would look at more ancillary companies as compared to real estate companies as of now. That doesn't mean that in 3 months we would change and do that, because this is a space we are looking at based on the pricing on a regular basis. When we're talking about ancillary companies, it's there are many sockets which we are looking at. There were cement companies which we are looking at in the small cap space, because there, A, the cement demand is increasing. B, the EBITDA per ton, courtesy, price increase is improving. So even if there were coal price hikes which are happening, you're being able to pass it on to the end consumer. We're looking at building construction and pipeline spaces. So all these spaces we are looking at in a reasonably big way, the FMEG space. Having said that, currently we don't have a lot of this in our portfolio. These are things we are looking at as we talk, just to be fair.
Okay, so you're comfortable buying some of these at the current valuations, because almost everything which is real estate ancillary has had a really good run in the last 18 months.
So, which is why, Niraj, I said we don't have it today, much in our portfolio. What we have, if there are corrections, we'll look at it. This is a space we're looking at a lot more. The other three spaces which we mentioned, be it in defense, be it in Capex, be it in the consumption, we are buying immediately, again, with a function of, are they at their weighted average P of the last 5 years? Or more importantly, there could be a case in point of companies, let's say in the cap goods sector, where their peers are trading at 40, 50, 60 times. But, let's say companies like Kirloskar Oil, Vatek, which are sub 15, 16 times multiples. We're focused on those names because there we've got a valuation feel-good factor. That's very crucial for us, Niraj. At this environment, to just get carried away with earnings and not look at valuation is not our style.
Vinay, I wanted to get your take on a couple of spots of exuberance, perhaps, maybe in the last couple of days. Indian IT defying expectations as we speak in terms of performance, and yes, from a relatively short-term view. Wanted to know if you have a take there. The banking space, and the third, if I may add, is the whole renewables play. Like you said, in the point of Capex, or in the context of Capex, policy push very clearly on building, policy push also very clearly on building green. So, if you have a take on these three spaces.
So absolutely. So let's first go to IT. The way we look at IT is you break down IT into the yesteryear's IT, the big large cap companies which are a lot focused on, obviously digitization, AI. But they depend a lot more on the global mandate which they get. And if there is a global slowdown coming in the next 3 months, yes, interest rates will fall, and these stocks have moved up. We're keeping them, but we are avoiding them currently. We were underweight the IT sector for most of last year. We're actually inching up in the IT sector, but what we are buying really is the mid-cap space. And here's where the ER&D story I was trying to tell you earlier comes into place. If it's companies which are, in the data analytical space like Persistent, or if they're companies which are in the ER&D space like Cyient and AccessCAD, where you have the advantage of one, airlines, going crazy because of the demand which they're getting, and, seating arrangements being required for them, and these are 5-year projects. Two, you're seeing the EV story. Earlier you had just a KPIT, but now you're seeing orders go to, even companies like Cyient and Axis, CAT. What's also interesting is three, you're seeing a lot of defense stories emanate in terms of software coming in the IT space. So we are a lot more mid-cap focused in the IT space, but we are inching up to being equal weight to the IT sector, but buying the new generation IT names, if I may use that word, as compared to the older generation IT names. That's your first question. Moving to the second question on banks. The way we look at the financial space is we break it up into the lending space and we break it up into the non-lending space. In the lending space, we are very excited. Our financial analysts as well as economists, Pooja and Anirudh are very excited on the loan growth of the country. The 20% number may be a little bit of a misnomer because you've seen HDFC Limited come in. So if you look at net of HDFC Limited, you're seeing 17-18% long-term loan book growth. Even if that were to go to 16%, the banking sector has never had such robust balance sheets. You've not seen such high quality capital adequacy ratios, but you've also not seen a retail growth of as much as 30% year and month on month. And you're seeing that number just get repeated, and everybody tells us be careful because the NPS could be the next place to focus on, could be with retail NPS. The Capex cycle is still to come out. So there's a big story coming in there. So that space, we have lots of interesting ideas, in the overall space, but MFI space also is looking very, very appealing. Just to name one of them is Fusion, something which we are looking at in a big way because one of the few companies which warned us that there is a lot of rain coming up in North India, because of which their loan book growth may not be 30 to 35%, maybe a notch lower at 20 to 25%. They raise capital, their capital adequacy ratio is 25%, and they have a ROE of as much as 5%. So lots of good ideas. But, again, bottom up is really the way to go. So these are the two questions. Could you just get me back to your third question?
Renewables, and completely my fault for bunching up so many questions together, Vinay. Apologies for that. The renewables green push. So whether it is companies financing them, companies on the tech side of it, or then the final product, all of them seem to be seeing a lot of enthusiasm. I wanted to know if you've been able to sift what is real and what's not.
So, what we are looking at the renewable space clearly is the finance space. And again, we are working on that. We have not nibbled into it, but, we are looking at the finance space. And here in the renewable space, you have two stories, right? One is in the finance space, what are you going to get? What are you paying for in terms of price to book? Are you paying 1.5 times or 3? We're kind of avoiding the 3 times companies and focusing a lot on the 1.5 times price to book companies. The second part of it is, again, I'm going back to the Capex related to the renewable space. Is not the people who are purely doing the renewable space, but the people who are doing the EPC contract. Are they companies whose balance sheets have changed overnight or in the last month or 2 months? Are these companies wherein what you're seeing is all of a sudden they're net cash, or they will become net cash this month? And the biggest problem for the EPC companies historically was balance sheet, and balance sheet, right? These were the 3 big problems because they didn't know how to invest, how to get, loans at cheaper rates. There were problems of them on the working capital and the cash cycle. So the same story which we used earlier on the Capex cycle, we are using on the renewable space. And I agree with you. Some of them have really moved up, but we are really eyeing the utility space, pure yesteryear utility space, and more importantly, couple of the EPC names where we think the net debt is vanished all of a second, and earnings growth trajectory is super crazy, because what is the government will increase Capex in this space. That a couple of gigawatts per year is a done deal for execution, be it in India or be it in the rest of the world. So the companies which have the bandwidth to do that are where we are focused on.
Absolutely. Thank you so much, Vinay Jaising. Absolute pleasure speaking with you today on NDTV Profit. We'll take a very short break, but the excitement continues, because on the other side, we have Maruti Suzuki's Shashank Srivastav to talk about the company's road ahead. watching the India Market Open. We're talking now with Shashank Srivastav, Senior Executive Officer of Marketing and Sales at Maruti Suzuki. Mr. Srivastav, thank you so much for speaking with us. Pleasure to have you on NDTV Profit for the first time since December 8th when we have launched. So superb to have you here and talk about Maruti's journey. So a touch of nostalgia in the last few days when we saw that Maruti 800 has completed 40 years in India and, give us an opportunity to see how far we've come and what the next move is. So let me begin with that kind of view from you. The small car is now passé. Everyone wants, whoever is buying four-wheelers and passenger vehicles wants a compact SUV. EV is the new buzzword. Is Maruti also ready to abandon the small car as its mainstay, or is there still an attachment there?
No. First of all, I think it's disputable when you say, by the way, small cars still last year 34% of the industry. Even this year, just under 30%. The total sales there expectedly in this year would be somewhere like 11.5 lakhs. That's a pretty substantial volume. Maruti Suzuki last year sold about 9.5 lakh small cars. And that's like 1.5 times the total volumes of the nearest competitor. So it's not a small segment. And therefore, I think the segment in Indian context still very, very relevant, and I think would continue to be relevant for a long time.
What about growth numbers? Are they is the uptake of other segments or compact SUVs, like I'm saying, becoming higher than small cars in terms of growth trajectory? And forward-looking, are you seeing that changing? Or do you think that India is going to be a small car-dominated market for a while, that all the rest is just noise?
No, clearly the SUV adoption rates have increased. In fact, in the last 3-4 years, as a percentage of the total passenger vehicle industry, SUVs now are almost 50%. They were half of this just about 4 years back. So yes, the growth trajectory for the SUVs really climbed up, no doubt about that. In fact, much of the growth, about 8.5% for this calendar year in the PV industry, is driven by SUVs and the MPVs. SUVs growing almost 26% against a decline in the small cars. So yes, SUVs have grown, and our projection is going forward. They will play to around 54-55% mark of the industry. And as far as the small cars is concerned, our projection for 2030 is that while as a percentage, they may be about 24-25% of the industry, much lower than what they are today, but in terms of absolute volumes, would probably be higher than what they are today.
Fair enough. And what about Maruti's EV plans? We know that 2025 is the year when production begins. When can we expect a rollout? And the sense is that if there has to be a wider adoption of EVs in India, it has to be a Maruti product priced in that way. Is that the strategy going forward?
So for EVs, it's like this. 2024-25 financial year is when we launch the EV. And at the moment, the EVs are roughly 2.2% of the overall industry volumes. Expectedly, in 24-25, they should be around that 4%, 4.5% mark. And our research shows that whenever the EV market in a country touches that 4.5% type of mark, then that is sort of an inflection point after which the adoption rate for EVs go up. We have seen that happening in France, in UK, Germany, Korea, Norway, Netherlands, and so on and so forth. So we believe we are at the right time for introducing the EVs. Also, however, we believe that in order to meet the emission norms which have been set out by the regulatory bodies, I think EVs is still, for the reason of high cost of acquisition and the charging infrastructure leading to range anxiety among the consumers, I think the penetration which we are foreseeing for 2030 for EVs in India, EVs is about 20%. So it will increase, I think, from 24-25 onwards, but will reach about 20% by 2030. And yes, we have Maruti is always wanting to help this penetration and adoption of EVs, and one of the big ways of doing it is to localize the battery and battery components. Suzuki has invested almost 10,000 crores in battery plant and the related components. So I think that's one important part in trying to localize the battery, and battery, as you know, is 50% of the total cost of EV production. So yes, it should help us price competitively.
Will it be than what is currently there? Because that's the big barrier, isn't it? You have to pay more to go green.
Yes. So cost of acquisition, as I said, is a very important factor, which is currently pushing down the adoption of EVs besides the charging infrastructure. And you know, if you see the price to the EV price to the gasoline corresponding vehicle price, the ratios are most adverse for the smaller cars, and it's much better for the SUVs and the larger cars. So the adoption of EVs would probably be faster in the higher end, and that's why the reason why Maruti Suzuki also will be introducing its EV in the mid SUV space, and that's something which we have already confirmed to the general public.
All right. Well, so mid SUV EV expected by 25. One last question: how much are the price hikes next year?
We haven't really decided on the actual percentage of the hike, but yes, it appears that the price would be across all models, and it would be in some models substantial. But the exact quantum is something which we are still working on.
Range, if you can share, Mr. Srivastav.
What?
A price range of the hikes, if you can share, if not the exact quantum, of course.
Difficult for me actually to say, because you know the impact on the input cost for various models is different depending on the so it's a little bit difficult for me to give that range here.
Okay, fair enough. I tried though. Thank you so much, Mr. Shashank Srivastav, for speaking with us and answering all of our questions today. That's a wrap on the India Market Open, but stay tuned. A lot more coming up on NDTV Profit. Up next is the Econo Show.
Hello and welcome. This is the F&O Show. I am Agam Vakil, and in this show we take you through all that is happening in the futures and options space in Indian equities. But before we start, a quick look at the headlines. It's a wonderful Wednesday on the Lal Street as markets open at fresh record highs. Nifty about 21,000. Sensex moves over 71,800. Broader markets outperform. And all sectoral indices paint a fresh coat of green, pulled higher by the IT index. FMCG, media, oil and gas and metals follow. And Varun Beverages pops over 18%. Stock hits an all-time high on its acquisition of South African company Bevco. And it's a stellar debut for DOMS as it sees an over 77% premium to its issue price. Meanwhile, India Shelter also lists on a strong note. And RBI cracks down on misuse of alternative investment funds. Funds worth 20,000 crores will be hit. Now, those are your top headlines. A quick look at the markets. At the moment, we are seeing strength. And as far as the Nifty is concerned, we are continuing to see some longs building up. Currently, comfortably above the mark of 21,500. We are seeing about a 0.5% gain, and it's the same for the Sensex as well. But I reckon that today's day of trade will also be having the Bank Nifty, which will be in focus, considering we have the weekly options expiry. Now, the Bank Nifty is underperforming by just a notch when compared to the Nifty. Sure, it's up around 0.2 of a percentage point, but it's lost out on the 48,000 mark at the moment. And even when it did have a strong, opening, we've seen a little bit of a moderation in terms of its price through the course of the morning. Are we expecting a reversal? Are we expecting a little more volatility? Are we expecting further weakness? That's something that we will get to know eventually down the line. But this as far as the Bank Nifty is concerned. Also, as far as your mid-cap and small-cap indices go, let's take a look at how they are doing as well. And outperforming the benchmarks clearly, at least as far as the mid-cap 100 is concerned. That's up around 0.8 of a percentage point. And the small-cap index is also advancing by well over 0.6%. So, gains all round. And from there on, let's take a look at how the futures and options space is panning out. We start off with the benchmarks, and in general, at the moment, of course, the Nifty is seeing an increase of around 2% in open interest towards longs, a little bit of a trend that has been coming through over the past couple of days. We continue to see more and more addition in open interest. This is despite the fact that the expectation was that we really wouldn't see too much interest as far as the benchmarks are concerned, but that's not exactly panning out, and we are in fact looking at that increase in OI. Let's bring up the Bank Nifty as well and take a look at how that's performing. So while it does advance by around 0.2 of a percentage point, we do have a little bit of a decline as far as its open interest is concerned. I reckon to a certain extent, this will be a bout of profit taking. Moving on, to talk about your options status, at the moment, we continue to see the 21,500 call as the one with the maximum open interest. Will that be a hurdle in the moment? Not necessarily, because we're already, at least the underlying is already trading above that mark. But the question is that can we expect to see unwinding? So let's pull up the change in OI, and there you have it. We are, in fact, starting to see a little bit less activity in terms of the 21,500 call, and puts being written around the same mark as well. So it is going to be